In the video yesterday, we were looking at how I prefer two moving averages over no indicators at all. But when you look at some of my charts, you're going to say that I use three moving averages. Is three moving averages better than two moving averages? Now, I use three moving averages, and I'm going to show you exactly how I use them. It might be a little bit different than you think. Now, when we have two moving averages, like we had in the last video, with the two moving averages, we get the core concepts of what we need to see. We get to see a trend direction. When the moving averages are up, we got the 20 over the 50. Now, again, yesterday's video, we looked at these moving averages as the 21 and the 55. We're going to the 20 and the 50 because this is part of a system called the Trinitas. Now, the 20 over the 50 gives us an uptrend. The 20 under the 50 gives us a downtrend. So we get an idea of the direction we want to trade. Now, when the price pulls away from the 20, we have overextended market and we need the price to retrace back to that 20. And we can see that here and here and here and down in here. When the price gets away from these moving averages, it needs to pull back. But when the price gets to or close to the 20 EMA, we're looking for the price to move. It's a launching point or a sweet spot. We look for the price to take off from these areas. So we've got that one figured out. So we have all the major parts of looking for a trade. But I'm going to throw in a third moving average. And I'm going to show you exactly how I use this third moving average. Now, this third moving average is going to be a 200 EMA. So we'll just add that to the chart. I made this lighter than I usually use it because of the videos. I noticed that on YouTube, the compression is such that these indicators and the colors kind of dim a little bit. So this is a little bit of a lighter gray. I generally use this indicator as a darker color because it's not my central focus. I don't want to focus on this one indicator. I want to pay more attention to this red indicator, the 20. However, let's take a look at what this 200 does for us. Now, we've got two kinds of trends when we add this 200 EMA into the charts. We have a technical trend and we have a tradable trend. Now, a technical trend happens right here. So if I throw a vertical line on the chart right in this area, I think we can move it over. Right here, what we're looking at is the crossover of the 50 above the 200. The 20 is above the 50. So we have what's called a technical trend. The moving averages are in order. And down here, we have a technical trend to the downside. So we've got, again, the moving averages in order, but this time they're bearish. So we've got the 20 under the 50, under the 200. Now, trading in a technical trend is ideal. This is what we'd like to do. This is preferred. We'd like to see that the trend is down. We are technically down. We are looking for the biggest moves in a technical trend. So we've got a down move here. We've got a lot of short opportunities in here, but generally we can see that the market tends to move down when we are in a technical trend. And on the other side, we can see that the market likes to make the bigger moves upwards in a technical uptrend. So if we go back to the beginning here, let's take a look at a tradable trend. Now, I've got some criteria. In order to start looking for a buy trade, I want the price to be above the 20 EMA, and I want the 20 EMA to be above the 50 EMA, and I want the price to be above the 200 EMA. Now, these moving averages don't need to be in an exact order. We're looking for the 20 to be above the 50, and I'm looking for the price to be above the 200. The 20 and the 50 don't have to move above the 200 yet, but 99% of the time, the 20 will be above the 200 if I'm looking for a buy trade. If the price is going to be above the 200 when I'm looking for a buy trade, it'll be bouncing off of the 20, and that will also be above the 200. Now, I'm going to write these orders in the description below. So if you want to refer to that order, you'll have it there. But let's take a look at a couple of opportunities here when we have this kind of crossover. So what we're looking for is in a downtrend, we're looking at this little instance right here. There's a nice sell opportunity right in this area here. So let's zoom in just a little bit. We've got a sell opportunity in here as the price is under the 20 EMA. The 20 EMA is under the 50 EMA. And in this area here, the price is under the 200 EMA. Now, we're not in a technical downtrend yet. we don't have all moving averages in order. But what we've got is the market underneath all the moving averages. We've got the medium-term trend down. Price is pulling back. We've got this white candle pulling into that 200, getting close to that 20 EMA. And from here, we're looking for a short trade. So underneath this white candle, we'd be looking for that shorting opportunity. Even though the moving averages aren't technically in a downtrend, this is a tradable trend because the position of the price according to these moving averages. We're looking for something to the upside. This would be a nice opportunity to buy. Again, right in this area here, we do not have a technical uptrend. So in this area, we've got price above the 20 EMA, the 20 EMA above the 50 EMA, and the price is above the 200 EMA as well. So at that point, I've got a tradable trend. So I'm looking for a trading opportunity at this point. The price is above the 200, and then we're looking for a pullback into or close to that 20 EMA. And then from there, we're looking for a move up. And again, we get our buy trade just above this gray candle here. This would be an entry order. We'd be looking for a nice buy opportunity in this area here. So when it comes to the 200 EMA, the 200 becomes a bias rather than a trend. Now we have two trends. We've got a medium term and a long term trend. The 20 over the 50 is a medium term uptrend. The 50 over the 200 is a longer term uptrend, but it's not the longer term uptrend that I'm too focused on. What it is the price in relation to that 200. Is the price above the 200? Or is the price below the 200? Once the price gets above the 200, the market tends to drift upwards. And then once the price gets below the 200, the price tends to drop. And of course, we get a little bit of chop in here because we're in an off session. But when we have a market that is moving, we could see that, if I zoom out, once the price gets above the 200, we have quite a while the price remains above that 200. So I'm looking for buy opportunities in this area. It doesn't matter if the 20 and the 50 are hugging the 200. I'm just looking for the price to be above it. And I'm looking for these two moving averages, the 20 and the 50, to be in the right order. So at this point, I'm looking for a long trade. And in this point here, in the middle, I'm looking for sell opportunities. So at this point, at this candle here, on this candle, we have all the criteria met for a tradable downtrend. We've got the price underneath the 200. We've got the 20 dropping below the 50. And at this point, I can start looking for those sell opportunities. Now, I don't get one until the price pulls back in this area here. We get this pullback. It gets towards that 20. And from here, I would be looking for an opportunity to sell. And again, that shorting opportunity would be, it could be below this candle, but this one would be the safe one. We go below this white candle. This is called a pullback candle because it is against the trend. The trend at this point, the tradable trend, is down. So a candle that prints against that or in the up direction would be a pullback candle. And in a uptrend, a gray candle like this one right here would be a pullback candle, and I'd be looking for my long entry above this candle here. So we've got three moving averages that I take advantage of because I know the bias of the 200 is either up or down. If the price is above it, I'm looking for buys. If the price is below it, I'm looking for sells. And I love these two moving averages, the 20 and the 50. They give me a trend direction. They give me oversold, overbought market conditions. They give me the ideal spots to look for an entry. So you combine all of this. These three moving averages are way more powerful to me than just the two moving averages. Let's take a look at an instance where we have these moving averages that aren't in agreement. So we've got, in an area like this, what I'm looking for would be a buy trade. As soon as the price gets above the 200, right in this area here, we're looking at seeing the price above the 200. And what's happening is the 20 is above the 50. So now I'm looking for opportunities to buy. Now what's going to happen is because the 20 is still away from the 200, price is going to drop down underneath that 200. And that is going to kibosh any kind of buy that I want to do because now the price is under the 200. So I'm not interested in anything at this point. We've got the 20 above the 50 and we've got the price under the 200. So I'm not interested in anything at this point. Now what happens is, again, we get an opportunity. The price goes above that 200. So now we also have the 20 above the 50. Again, we're looking for an opportunity. The price has not left the 20 EMA yet. We don't have these kind of gaps in here. We have it just leaving these moving averages. So at this point, I could be placing an order just above this candle here. We've got the price just leaving the 20. We're still fairly close to it. I could be looking at placing an order just above this gray pullback candle, because in order for that to be triggered, the price will be above that 200. And this gives me a really nice opportunity for a long trade right in here. So all the criteria is met. We've got a tradable uptrend. The price has come back towards that 20, and then it takes off. All right, so that is how I use the 3 different moving averages. When they are the 20, when they are the 50, and when they are the 200, those 3 exact settings is what's called the Trinitas. Now you can have different variations of 3 moving averages, but that is not Trinitas. That is just going to be a different set of 3 moving averages. You've probably heard of the 50 and you've probably heard of the 200 MAs over and over. If you've been at this for any length of time, you'll be well aware of these 2 different moving average settings. And in this case, we are looking at these settings as EMAs as opposed to SMAs. Generally, the Trinitas are SMAs. And we're going to take a look at that in a different video. We're going to take a look at the difference between the EMAs and the SMAs. And from there, you can decide which one you like the most. But either way, you are trading with the Trinitas moving averages.